So we talked about this, sort of this last refuge of any kind of bear market historically is this 87 to 78% retracement zone. We've kind of popped into that, into the S&P and backed off of it. We've got more than 3 weeks of new high, new low net divergence. So we're kind of going to be watchful of a potential correction that could be decent, could be better than a normal correction against this bullish trend that we're not sure how long it's going to last. So we really want to be watching. We haven't yet had short-term indicators turn down with a plurality. They're really close. And we haven't yet had a correction warning. We'll need a 70% down volume on some pretty high volume to have that happen ahead. So we're really watching that really closely. And that would be sort of a trigger to take more defensive action. You can see that we got one of the reasons that we're kind of looking for potentially that's becoming a higher degree possibility that we get a correction is because we have hit a bunch of resistance levels and a lot of different things at the same time. And that's one of the things that you really look at technical analysis for. When you get a lot of things hitting a resistance level at the same time, starting to back off of it, that tends to be more of a move off of that than you normally get. So we have, again, the NASDAQ, for example, hitting into this weekly HVN, a strong HVN, getting into it, backing off, making a double top on the daily chart, breaking down, breaking this uptrend line. So you look at the daily chart below. Here's your uptrend line since March, has been very nice and steep. And for the first time since then, you're closing below the 50-day DMA, and you're closing below that uptrend line after having this nice double top and that coming off of this HVN in the weekly chart. And within in small caps, equal weights, a lot of different things. We got a lot of big cap stocks that have hit resistance, have backed off. So there's a lot of reasons to expect that we're at least going to start to turn sideways, if not get a decent correction. And we'll talk about what that means potentially. But the other thing to realize is that what precipitated this action was a breakdown in TLTs. And we've been talking about that on Reed's Trader for a while, that, you know, TLTs, the long bond is getting down to these support levels. And if you break those support levels, you're going to start to get spillover damage into equities. And that's really what dragged this sort of mini correction that we've had so far into happening, which has, by the way, been bigger in international markets than it had been in the US. I want you to just, look at both of these. This is the TLT daily, which is the bond chart, the inverse of the yields. And this is the yields. And I just, we had this secular breakout in yields so that the trend is higher. And we've had a pennant breakout that projects 10-year yields up to 5%. And we're getting this sort of breakdown in TLTs and long bonds. And so it's the bond action that's driving things. And one of the things that's been troubling for us in this rally off the October lows is that really every major cyclical bottom since the Federal Reserve was founded has had the bond market go through a prolonged and substantial rally before stocks bottomed. We haven't had that this time. There have been times such as October 78 to early 1980, October 1998 to March 2000. There have been a few times where you've had these sort of non-cyclical moves. They're moves that lasted 6 months to 18 months. They were rallies, but they weren't cyclical bottoms. And what happened is the bear market that followed took out those lows fairly quickly. So that's that. We don't really have the typical bond action leading stocks that we've had. And now, in fact, we have bonds potentially making new cyclic highs. That looks more like a 1970 type situation than it does like we've got a real, bear market bottom that's going to hold for a whole cycle. So really want to watch bonds carefully. Again, we're testing these all-time lows. We've had breaks of these October levels in other global bond markets, in the German bond market, European bond market, in Japanese bond markets. And so oftentimes these big moves in long rates happen globally in the developed markets in sync. That makes it more likely that we're eventually going to break these lows, although I suspect there'll be a battle at this 4.33% on the 10-year bond yield high. But eventually the secular trend is up, and we're going to talk about some of the reasons why that's happening. We got negative inflation news potentially coming. We've got oil prices rising, and remember, oil prices were the big reason for the decline in inflation so far this year. Now they're up 25% off the lows and starting to try to break out of really strong bases on a plural basis. That would be something that would really put the inflation concerns up again and lead to more problems for long bonds, and then more problems for long bonds. As we break these lows, it's going to be pulling stocks lower potentially. So we really want to watch out for that. And we can see that we've had both sentiment and some positioning, not all of them, but some positioning indicators getting to extremes that often sometime in the next few months mean some kind of correction at least. And then we've never really kicked in fully all cylinders into gear on internals. It's a very mixed market background. We've had the New York Stock Exchange advanced decline line finally breaking above the February highs, and the same thing with the OCO, or the operating companies only advanced decline line, but none of the other major internals, not the unique cumulative net volume, not net points, not net new highs, new lows, and not the McClellan summation index. None of those have broken the February levels. So we got divergence here, and we have an internal picture that's still not really fully kicking into gear and not saying, yep, this is something you want to be buying with both hands. Really similar picture on the supply and demand, our proprietary supply, demand, and spread indexes. We have really strange phenomenon where normally in a new bull market, demand, the orange index here, is stronger than supply is weak. And remember, supply moves in the opposite direction of the market. So normally you would see demand that would be breaking higher and strong and leading stocks higher. We don't have that in this bull market. We have a decent downtrend in the supply index. It's making lower lows and lower highs, but the demand index is just dead. It's in a trading range, worse than small caps. And so if you look at the net index, it's still not breaking its Feb highs either. You had to look at this, you would say, this is a mess. It is a sideways market, but it's really not confirming what's happening in the major index. So we don't have definitive action either way. It's kind of mixed internally, and until that, we're not really going to get excited and dig in with both hands in the bull move. You certainly want to participate, and you want to participate in the strongest relative strength sectors, and you can get decent moves out of them. We had periods, 1998 is an example, where you never really got the internals to fully kick into gear, and you got really great new highs in the NASDAQ and decent new highs in the S&P, while the small caps kind of went into a bear market. Okay, so it's the technical internal situation makes stocks potentially vulnerable to higher rates and higher inflation numbers. And as we'll discuss, markets are really going to be focused on the inflation numbers carefully now, because they have a narrative which is a very, very difficult high wire act for both a soft landing and for inflation to come down to target levels early next year so that the Fed can begin cutting rates. So we don't have a correction warning yet, but if we get one, probably looking at something like 4,200, 4,300 as kind of a minimum target. And we really will want, because the compass of the internals really isn't giving us a very clear picture, we want to be watching things really carefully if and when we do get a correction warning, we want to be looking for things like multiple 80% down volumes or a 90% down volume, or things that show us that, okay, this is getting worse, right? You remember in the 2001 decline off the high, within 4 days of the high, we got 90% down volume, telling us, yes, you're already expecting a major correction, but this is going to be worse than you expect. So we really want to watch carefully. We could get one of two scenarios. We get a correction. We could get a situation where, yep, the internals start looking like a lot of supply coming on, and that tells us, okay, this is going to be deeper than we think and maybe get pretty nasty. Or you're going to get a regular, more normal type of correction behavior. And that's when you're looking at, okay, we may have another rally off 4,200, 4,300 after we turn around and get a correction over signal that we can play. But again, we want to play it lighter than usual because we don't have other indicators in sync with it.